Hello, hello. Let me see if I can do one thing here. Hello, everyone. I'm live off my phone. This is weird. I've never done this before. Hope everyone's doing well. Morning is the day after the Fed announcement, and we got a 75 base point hike as expected. 75 bips, and the expectation for another 75 bips is like 90% from yesterday. And it's pretty interesting as to what happened. What the hell did I just do? The potential for a soft landing is pretty much gone and over with, right? We've seen the expectations of that soft landing really disappear from that FOMC that happened on Wednesday. The question now appears to be, how hard of a landing will there be? So things couldn't have really been more hawkish realistically. With the Fed's dot plot that showed 4.4% by the end of this year, as well as a terminal rate of 4.6% in 2023. So dot plots are very interesting things to note. In terms of those dot plots, they really exaggerated the expectations of almost 5% by the end of 2023 before we would see any type of rate cuts, right? Those rate cut decisions came 2024 potentially, and that means that we have a year in 2023 and then the remainder of this year, which is October, November, December, 3 more months of a really tight policy along with quantitative tightening. Now, before this meeting, the expectation by the end of this year were 3.5% and then 2023 3.6% respectively. So what's going on? And this comes with higher inflation estimates that were included in these projections, with unemployment going up to about 4%, with, what is this? With an assumption that there's no change in the U.S. workforce. Obviously that does change. Some highlights from Fed Chair Powell. Geez, what a tough morning. We have to get inflation behind us, and there were, what did he say here? Reducing inflation is likely to require a sustained period of below-trend growth, and there will likely be some softening in the labor market conditions, resorting to price stability, and which is essential to set the stage for achieving maximum employment and stable price over the long run. So we will keep at it until we are confident that the job is done. So this pretty much says, in the short term, they don't really give a shit. He pretty much reiterated what he was talking about throughout the Jackson Hole, and that suggests that they're going to keep this super tight. Labor market's going to take a beating. Consumers are going to take a beating, right? General households are going to take a beating. And the lower to mid-tier income families and people are going to take a beating based on these higher inflation prices. But that is a sacrifice, essentially, that the Fed is willing to take in order to restore the longer-term growth in the economy generally. So case in point, we saw that futures closed super bearish. We dropped through a lot of different distribution blocks up to the downside, a slight little rally here off of the lows today, which I do expect to see some kind of continuation throughout the day. We'll see if we can hold some of those distributions, and a key is a distribution low right now is going to be 37.95, 94. That's going to be the low area of the distribution, so that's an area that you have to really keep in mind on the S&P futures. We also saw the 10-year Treasury spike 7 bips to 3.64%, and the rate on the shorter 2 years spiked about 15 bips at 4.11%. So futures overnight gained a bit after nearly dropping 2% throughout the session after trying to climb into the 3900s. And investors pretty much fear that Powell even mentioned the possibilities of a recession. So that in itself is something that we haven't heard of yet. And he did reiterate a lot of, he mentioned a lot of the 70s and how that shaped up in terms of the inflation and how they're going to have to keep a tighter policy. Also, the deceleration in housing prices that we're seeing should help bring a sort of prices more closely in line with rent and other housing market fundamentals. And that's a good thing. This is what Jerome Powell said for the long term. And what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level and at a reasonable pace, and that people can afford houses again. And I think So we probably in the housing market have to go through a correction as well to get back in place. And again, housing or shelter and food are one of the main contributors to inflation that we've seen over the past bit, right? Energy prices as well, but shelter and food have consistently continued to go up, especially I know even in Toronto and like a lot of the major cities in Canada, we've had this massive housing boom that's really affected a lot of the renting price as well. Right now it is pulling back, but rent is really high, and the affordability on houses is very low, which brings to question, right? When all these mortgage rates go up, especially in the US, 6.25% for the 30-year, the highest since 2007, who is able to continuously afford those mortgages that they were buying at 1.5 variables, at 2% variables, right? It's going to change a lot, and that correction is going to have to happen. And of course, the consumer, again, is going to be the one that gets hurt. There's a few other things that we do have to talk about going forward with Fed Chair Powell and the Fed, right? We have a meeting in November. We have a meeting in December as well, and realistically, those are both priced in for 75 basis points. Again, between 4 and 4.5% is the general consensus target by the end of the year for the Fed's funds rate, and that's going to continue into 2023 as well, which is going to put a lot of downside pressure on tech names, right? Inflation is already putting downside pressure on tech names, but these high rates is really going to knock things down. So it's something that we do have to consider. And will we see a bottom in the market this year? Probably not realistically. We need to get a lot of this tightening out of the way and see inflation actually tamed to that 2% level, which is something that I don't see in the near future. In terms of consumer defensive, right, nearly every sector was pushed down throughout the Fed meeting. But whatever strength there was left appeared to be in the defensive consumer staples industry. We had names like Kellogg, Campbell Soup, Kraft Heinz. What else do we have here? Smucker, right? These stocks tend to do better than broader markets during recessions and price at high volatility. So that's consumer staples sector, XLP, which has been doing fairly steady, right? Like even on massive drops, it won't drop as much. Cheerios maker General Mills, I think it is, drove the momentum, finishing the session up 5.7% after a strong beat and raise earnings report. Sales rose about 4%, right, to 4.72 billion, in line with Wall Street estimates, which was held by lower than expected elasticities, strength in the North American real estate business, and higher prices, which added 15 percentage points to the top line. Adjusted earnings came in at 1.111 per share, beating the consensus 0.11, so by a full dollar. Significant inflation and reduced consumer spending power has led to an increase in at-home eating. Other value-seeking behaviors as well came from the CEO. We continue to deliver strong performance in a high volatility operational environment. So this is the expectation realistically. If you're looking for areas that are less affected by recessionary actions, right? You're looking at consumer staples. You could even be looking at energies to a certain extent, but consumer staples, right? The premise behind that is that you're getting a product, right? That's a need, and they're going to do better, right? Like that's a good point. You continue to see the stay-at-home eating. You see stay-at-home this, stay-at-home that. Everything that contributes to not spending money on wants rather than needs is going to do well realistically. So, Michael, how does one get long ramen noodles? You got to figure out who makes the most ramen in the world and just get long, which is, like, honestly, like, sounds funny, but could be one of those interesting plays. We also saw the yen, right? Yen intervention out of Japan. Japan has intervened in the foreign exchange market for the first time since the late 90s, right? In an attempt to shore up the beaten up yen after it breached a key level, 145. So the currency buying bumped the yen back up to 140 per dollar, though many caution that the move will only provide a temporary reprieve and may be unsuccessful in the long term. So Japanese Finance Minister Suzuki also didn't disclose how much the government had spent on buying the yen and whether other countries have consented to the intervention. So ultra-dovish policies in Japan are keeping the yen under pressure. We've seen Japan be ultra-dovish for decades now. And this led to a strong wave of constant dollar buying in the forex market. And the yen, along with the euro, are by far the most traded currencies against the dollar, and both are weak. It makes it harder for anything else to rival the greenback. And the Bank of Japan also wants to ride out recent price pressures by sticking out its yield curve control policies, hoping that the current levels of inflation aren't sustainable due to hiccups through post-COVID. So Japan was one of those economies that still really sticks by inflation being a byproduct of what had happened throughout COVID, which obviously there's a lot of truth in that, and that those price stabilities will actually regulate themselves. And realistically, it's been a little too long for that to happen. Koda also said, the Bank of Japan Governor Koda said, I believe we won't be introducing a rate hike anytime soon, right? That was the expectation even yesterday. And we have decided to continue the monetary easing after thoroughly discussing what the most effective monetary policy is by analyzing the Japan economy, price trends, and future development in depth. So Japan is growing increasingly isolated on the global monetary policy stage, with most major economies pulling their short-term rates out of negative territory. And the Swiss National Bank even raised the policy rate by 75 bips. Even ECB, we saw the ECB by a full percentage point, which is something rare, right? They were behind the curve. And then Japan now is still sitting behind the notion that inflation is kind of going to correct itself, while the U.S. over here is increasing rates drastically over the next few months to really keep those monetary policies really tight, so that we do see inflation get subdued. And that seems like the only thing, because even with all these rate hikes, we're not going to see the effect on the inflation until we see like quarters, months in advance, and you're going to see the deceleration of inflation. Realistically, it's already the deceleration has started, but the drop in the actual numbers hasn't been seen just yet. So with that continuation, right, we have different economies throughout the world that aren't necessarily cohesive in this quote-unquote fight against inflation, and a lot of them are going to be left behind, right? You are going to see deeper cuts of recession in different areas in the world, and obviously they're all very interconnected, and you see supply chains that are very interconnected, which can put a lot more downside pressure on economies that have been doing what they should be doing to get that inflation subdued. For example, right, like let's say the US, right, they get inflation kind of down, but then the supply chains are affected by different areas around the world that are intermingled into their economy, which could put a little more downside pressure before we see an actual bottom. So to leave you off with that, right, it's still up in the air. We have CPI data that comes out in October naturally, and we'll see how that shapes up. But the downside pressure on these rates, we expected 75 basis points yesterday. We got 75 basis points. Why a lot of this downside? Fed Chair Powell pretty much reiterated what he had talked about before and kept a super hawkish tone. And even though we knew that, you still need that reminder, and the market got reminded very, very swiftly. So I'm going to take a look at what's going on in terms of we know in the Fed. So let's just keep that in mind going forward. I am slightly a little bullish. We'll see how those areas of support hold if there's a rebid there. And let me see if I can get this internet under control, because again, this is just from my screen, my phone. So I'll see everyone in the trading rooms, open those trading rooms up, and we'll chat tomorrow to end the week. Thank you all, and chat soon.